it feels like researching this story, everything happened in this time period. And I have a question for you. What do Charles Dickens, Charles Darwin, Emily and Charlotte Bronte, and John Stuart Mill have in common?
They are all featured in the story of Railway Mania, which is
That's
what we're
right.
about to get into. Yeah. No, after doing this research, I have a major new bucket list trip that I have on my list, which is I just want to spend a month riding around the UK on the rails and stopping in Scotland and Ireland and all the places.
Yeah, I'm with you. Ready to dive in?
Let's do it.
Welcome to the 8th episode of Season 2 of Backtest, the podcast about defining moments in market history and their timeless lessons. I'm Daniel Gamboa.
I'm Matt Harris.
And we are your hosts.
Before we dive in, a quick reminder that this show is for informational purposes only, and it is not investment advice. Daniel and I may have investments in the companies discussed.
So, Matt, you published a short piece a couple of days ago comparing the amount of capital being deployed in artificial intelligence to other capital cycles in history, right?
Yeah, so the main reason that we're telling the story of the railway build-out is that it's like the AI build-out in one really, really important way. They're both really expensive. The short piece I wrote put some numbers to it. And it's incredible what's happening with AI, right? Like we're investing $1 trillion to build out AI infrastructure this year alone. That's more than 2% of GDP. One thing the piece shows is that the level of AI spending, even right now, it dwarfs things like telecom in the 90s. But when you put AI CapEx into a broader historical perspective, that's definitely high, right? 2% of GDP, but it's not the highest ever. Actually, it's dwarfed by the railway boom in the 1840s in Britain, where at one point they actually invested 7% of their GDP in the railways in a single year, which is nuts. That's 3 times what we're spending on AI right now.
Right.
But the projections are for us to start spending closer to 4.5% and even 5% of GDP on the AI build out. So really the only thing to look at for that level of CapEx is the rail build out. So there's a lot to learn here. This is an incredible story. Our main character today he's truly an epic guy. And the railway mania market is really fascinating, both from a history perspective and from a markets perspective. I think we can agree this is probably the most ambitious research project we've tackled yet on Backtest. Yeah. And we need to thank 2 people without whom we would have been lost in the woods trying to put this episode together.
Yeah, 100%. Huge shout out to Andrew Odlisko, Professor Emeritus of Mathematics at the University of Minnesota and world expert on financial manias and fellow market nerd too. We will be linking to his research in the show notes. He does truly exceptional work, and he's been doing this for a couple of decades now. And we are forever grateful to Andrew for his help and for his generosity, getting on multiple calls with us about this and answering a bunch of emails that we sent them full of questions, as we were trying to understand this.
Yes. So thanks a ton to Andrew. He helped us a lot with this. And also a huge shout out to Gareth Campbell, a professor of finance at Queen's University in Belfast, North Ireland. Gareth he's just a wealth of knowledge on UK railway history and financial markets. It's hard enough researching something that happened 200 years ago. It's impossible without the hard work of people like Gareth, who had really meticulously gathered and studied the data. It's like I thought I was throwing these insane market questions at him about like what was the dividend rate in 1837 and stuff,
right.
and Gareth, he just knows it off the top of his head.
Yeah.
And so we're really standing on the shoulders of some giants here with this episode.
Yeah. Thank you, Andrew. Thank you, Gareth. Really appreciate it. Well said, Matt. And for listeners who aren't aware, earlier this year, we turned our 80s on Wall Street series into a Socratic method case study. This is basically the case method concept pioneered by Harvard Business School. And we did a couple of these at the University of Texas and at Texas A&M, where we asked students to put themselves in the shoes of our main characters for the series. So Michael Milken, Henry Kravis, Ross Johnson, Fred Carr, Howard Marks. And we asked the students to think about how they would navigate the investing and operating decisions that our main characters had to make in the stories that we tell. And it was a lot of fun. So we're hoping to expand that to other schools in the fall and into next year. So we're actually already talking to Gareth about scheduling a case at Queen's University. So stay tuned for all that. Okay, Matt. So we left off part 1 with George Stephenson, triumphant, having just opened the first intercity railway in the world, the Liverpool to Manchester line, with all sorts of technological breakthroughs and economic implications. But of course, that was just the beginning, right? Because what follows a technological breakthrough almost always is a massive capital boom and often everyone's favorite type of financial story, a stock market bubble.
Yeah, so pretty much every framework for evaluating if an asset bubble is possible or probable includes a technology breakthrough because of how new technologies impact psychology. And so at this point in the story, coming into episode 2, we definitely have that, right? We've gone from, I think if I ride that train at more than 20 miles per hour, that my face might explode, right? Like people were actually concerned that they were going to combust if they went too fast, in
Yeah.
1820s. To now, here we are in episode 2, and trains are becoming a normal form of transportation for people and for coal and other kinds of freight.
Yeah. And what ended up exploding actually was people's minds, right? And so today, we're going to tell the story of one of the most fascinating stock market bubbles in history, but more importantly, one of the most significant, maybe the most significant capital investment cycle in history. And like you said, the only cycle that surpasses the current AI boom in terms of capital deployed. We're going to tell the story of the 1840s railway mania in the UK. Not the only railway bubble, there were actually three, but certainly the biggest one. And we're going to tell the story by following another George. This other George didn't invent a new technology, though. He didn't invent the locomotive. He's not the father of railways. He's the railway king. His name was George Hudson, and he's the most important industrialist that you've never heard of, who at one point controlled a third of all British railways during the boom in the 1840s, who became not just one of the most powerful capitalists and builders of the era, but at the same time was also one of the most powerful politicians. This George, though, George Hudson, would go on to have a very different legacy than George Stephenson.
And this market period that we're about to talk about is one of the most important periods in market history, not just if you want to understand, the classic boom bust patterns in markets and even where modern corporations and modern accounting practices really started, but this is also the first time in history where we see markets really flex up to fund huge capex projects that weren't wars, right? No, the markets had never funded anything even close to this big. Some of these individual rail projects cost more than 1% of UK GDP just by themselves for one rail project. So these are huge projects.
Yeah, indeed, massive projects. But before we dive in, a quick thank you to our presenting sponsor, EQT Corporation.
At Backtest, we study market cycles because patterns from history rhyme. There's an important undercurrent in this Railway Revolution series where we're in the middle of the Industrial Revolution, where steam engines, railways, strong iron, and most other technology breakthroughs live on a platform of ample energy supplies and the infrastructure needed to get energy where it needed to go.
Yes, which is exactly what we need to support the build out of infrastructure today, particularly around AI. And the company unlocking energy resources to power AI is EQT, producing American natural gas to help deliver affordable, reliable energy at scale.
All right, Daniel, take us into this story.
All right, here we go. So, to really understand George Hudson, we need to go back to the very beginning of the century. George Hudson is born in 1800 in Howsham, which is a tiny farming village about 12 miles outside of York in the north of England. He's the fifth son of a farmer, and his early life is pretty rough. His mother passed away when he was 6. Father dies 2 years later. So by the time George is 8 years old, he's an orphan. His older brothers inherit the family farms and they help raise George for a few years. But in 1815, at 14 or 15 years old, they send him to York to apprentice at a drapery called Bell and Nicholson, where they sell fabrics to dressmakers and tailors. And he finishes his apprenticeship in 1820. And the next year, he marries Elizabeth Nicholson, the owner's daughter. So he's 21 years old and he gets married. And this is 6 years after joining, and he becomes a partner in the business. And when the other owner in the business retires, the firm actually changes his name to Nicholson and Hudson. So it's pretty obvious that George is a pretty ambitious guy. My guess is losing your parents at such a young age marks you for life and maybe instills in you a deep sort of desire to find security and safety, and you're going to go chase that the rest of your life. On top of that, one thing to know about 1840s Britain is that social status is a really big deal, and you can read a little bit of Charles Dickens and get a sense for that. Better yet, you can watch a show called Victoria, which is streaming on Netflix right now. It's excellent for this time period.
Yeah, really good. I'm enjoying it as well.
George must have been very aware that he's squarely middle class without much of a shot at joining society. George's wife doesn't really help this either. Apparently, she's pretty awkward. But even though George is ambitious and he's pretty sharp and he's a hustler, being successful in a trade doesn't really get you status. It doesn't buy you a seat at the table with the aristocracy that kind of runs things. And I think that gap between what George has and what he wants is one of the engines of everything that follows. He wants security. He wants wealth. Above all, I think he wants to matter. He wants to be a player.
The way I think about it, running a drapery makes it so that you're like just above survival,
Right.
in this society.
Right. And you're not part of society, right? Like it's a very stratified social structure. And so you're just not part of the people who are making decisions about what's happening in the city and what gets developed. And you're just another person.
Right.
So you don't really matter. It's how it might feel. And so sure enough, in 1827, life finally throws George a bone. He's 27 years old. He's this successful draper. He's married well. But again, he's just a middle-class tradesman. He's about to get the break of his life because George has a wealthy great uncle, Matthew Buttrill, who lives nearby. And toward the end of Matthew's life, George is visiting him a lot. He's keeping him company. All sounds perfectly benign, except when Matthew Buttrill dies, he leaves George a substantial portion of his wealth. So make of that what you will. There's no record of foul play, so we'll leave that there. What does matter is whatever the circumstances, the wealth that George inherits from his great uncle, something like 5,000 pounds in cash and a substantial amount of land, all in something like the equivalent of 3 to 4 million pounds today. This is going to change George's life. So overnight, George goes from being kind of comfortable with middle class to a very wealthy man in York. And more than that, he moves into his great uncle's elegant townhouse, which is this I have a ride moment for George. And he starts using his new wealth to make his way into society, right? He wants to be a player. And the game to play is politics at the time because everything, right? Society, commerce, trade, everything runs through these civic institutions. And you know what I picture? I almost picture him like a Victorian era Bud Fox from the movie Wall Street. But he doesn't need Gordon Gekko, right? Because the inheritance opens the door for him to become a player.
Yeah, that's a good analogy. Actually, I hadn't thought of that. George, he's coming into this life-changing wealth in 1827, which has got to be one of the most interesting times in history to come into serious wealth, especially if you have like some real-world business experience to go alongside it. 1827 is right in between the opening of the Stockton and Darlington Railway in 1825 and the Liverpool to Manchester line in 1830. And so to put that in perspective, right, the Stockton and Darlington represented the moment when the technology worked, right? Not just the engines, but also the rails, the total product that we talked about in episode 1. The Liverpool and Manchester line in 1830 really represents the start of mass market adoption. So this is really like inheriting a few $1 million in 94, right ahead of the dot-com boom, or 2022, right ahead of the AI boom, and being, in and around those circles and being able to kind of get into them and get into the best deals. It's worth noting that 1830 is the year that most economists believe that the UK shifted into a more modern per capita GDP growth paradigm of between 1% and 2% a year. And, it's not a coincidence that that's the first year of mass market adoption for rail technology. But at this point in the story, about 1830, George Hudson actually isn't focused on rail at all. One of the better books about him, this book called The Rise and Fall of the Railway King, said he was quick to involve himself in every new opportunity that York had to offer. So it's just a really exciting time that he's coming into wealth. He's got a lot of opportunity for a 30-year-old with real money and serious business acumen, right? Keep that in your mind as you hear this story. He had a good business background, right? He had a good kind of training ground running a drapery. Which is kind of like a regional retail business.
Right.
Is kind of the way to think about it.
And Matt, he's exposed to customers that are in the aristocracy. Those are some of his most prominent customers. And so he knows this market and he knows how to behave in those circles. Also very important.
Right. So businesses are growing fast. The Great Reform Act opens up influential government jobs to people with merchant backgrounds like George for the first time in history. All this is happening at the same time. But what George really wants is status and power, right? He wants to be the man. He wants to be part of the elites of society. And in Britain, 1827, the elites are concentrated in 3 overlapping spheres, right? It's land, it's politics, and it's finance. And everybody knows that the most influential people in York aren't merchants or shopkeepers, right? They're members of parliament. They're mayors.
Yeah, exactly. And so George naturally heads that way. And so he joins the local Tory party, the Conservative Party in York, and becomes the treasurer, which is a pretty powerful position at the time. If you think money is big in politics today, go read about the 1830s in Britain for a bit. The year after that, in 1833, he co-founds the York Union Banking Company, where he's the largest shareholder, which, by the way, Matt, do you know what becomes of the York Union Banking Company?
I do, actually. They became part of Barclays.
Exactly. This bank puts George in 1833 at the center of York society. He managed deposits and loans for local merchants. He's in the know, right? He's in the information flow. This gives him the kind of soft power that you might have as a local banker. And so taking a step back, you talked about what's happening in Britain at the time, that economic growth. George is watching all of this unfold from York, and there's kind of a big problem. The main rail lines that are connecting the big industrial cities like Liverpool to Manchester and some of the routes heading north from London, there's a project that plans to build a railway going north on the east side of the country, and it's looking like it'll bypass York. It looks like it's just going to go through Leeds, which is west of York. It was pretty obvious that if this happened, it would be a huge blow to the city of York. In hindsight, actually, I think it would have been a disaster for the city. So naturally, the leaders of the city get together, and this, of course, includes George Hudson, now is a major part of civic society and politics and commercial interests in the city. And George joins the newly formed York Railway Committee in 1833 as its treasurer and as its largest shareholder. And the goal of this committee is to get the line to go through York, to get a railway through York so it doesn't get left behind. So George throws himself into it. He's really good at this stuff. He gets organized. He goes and finds the people that are doing the work. He's riding along on surveys with the engineers. Actually, he rides along with John and George Rennie, the engineers that we talked about in part one that helped secure the parliamentary approval for the Liverpool to Manchester line after Stephenson's, disastrous appearance before Parliament. And so George Hudson is really learning the railway business from the ground up. He's figuring out how approval bills get through Parliament, how capital gets raised. And critically, this is where he meets George Stephenson, who at this point in 1833 is the most famous railway engineer in the world.
Yeah, so one thing that's interesting as you study this period is there's this huge thing happening, but this world is pretty small.
Yeah.
all these guys seem to know each other. And my favorite part of these guys meeting each other is, as we studied the space, there's a lot of bad information out there actually about this cycle. And you have to dig and talk to people like Andrew and Gareth and the real experts to understand what's going on. Every biography I read had a direct quote from Hudson to Stephenson, like they were all there. They all said that Hudson went to Stephenson and he said he wants to make all the rails come to York. It's hard to do a Yorkshire accent without sounding like a pirate. I've been working on it. But that quote was it was in like 4 different biographies. So he almost certainly said it. And apparently they got along really well, even though
they were friends.
Yeah. I mean, so some of the stuff I read said they were best friends.
Yeah.
Even though Stephenson's 20 years older than Hudson, I imagine Stephenson saw some of himself in the younger Hudson. They're both outsiders from the north. And I think, one thing we learned about Stephenson in episode 1 is he wasn't just a brilliant engineer. He also was a great salesperson, a great marketing guy. And I think he saw that in Hudson because that Hudson was extremely good at that as well. And so they had this really strong connection. That's a major part of the railway build out in the UK.
Yeah, for sure. Game recognized game, right? So George Hudson manages to get Stephenson on board as the engineer for what becomes the York and North Midland Railway, which is going to make York a key node in the early railway system that's developing in the 1830s to connect London to all the major industrial centers. And at the same time, George is climbing the political ladder in York. So he wins a council seat in 1835. He becomes an alderman in 1836. And by 1837, he's Lord Mayor of the city. And he's not treating being mayor as this like ceremonial gig or just being a statesman, just kind of above it all. He's using it as a platform. He's throwing a lot of lavish parties. It's kind of the ultimate power play. He's trying to build relationships and put himself at the center of it all, just like he was doing with the bank. And in a span of 10 years, George has completely transformed himself.
Yeah, so like if The Art of War had a chapter on social climbing, it would probably just cite George Hudson in 1835. Remember from part 1 that every new railway requires Parliament to pass a new law for each railway project. That's what gave the project limited liability and the rights to acquire the land it needed, and there's no way to attract investment capital at this time period unless you go through Parliament. Part of the parliamentary approval process is that you need a construction budget, and 10% of that budget needs to be already invested in the project from investors before you can even apply for approval for your new law. And the most important thing is the 90% gets called over the next 2 to 5 years, and it's the investor's legal obligation to fund that capital as it's needed to build out the railway. So, as an investor, buying shares means you're committing to that future funding. This is how private equity and venture capital work today. But the investors here are actually mostly individuals. And this is the first time capital markets are really flexing up to fund these really huge, 1% of GDP type projects. And so put a pin on that because this is a huge part of the story. You put 10% down, you commit to contributing the other 90% later. And if that sounds a lot like leverage, like using debt to buy stocks, it really is pretty similar. And so Parliament's approval of the York and North Midland Railway happens right around the same time in 1836 when the North Midland Main Line is getting approved.
Yeah, and Matt, maybe for anyone listening who's not familiar with UK geography and some of these historical projects, I know we spent an inordinate amount of time looking at maps as we were researching the story just to get a lay of the land. If you picture a map of England on the main British island, you have London at the bottom in the south. You go up the map, northwest of London, near the center of the island is Birmingham. And just north of that is the town of Derby. And then north of Derby is Leeds with York to its right, to the east. And then Manchester and Liverpool are to the left of Leeds, to the west, okay? And then if you keep going north, you eventually run into Newcastle and then the Scottish border. And so that's a little geography for you. So this is important because that North Midland line that you talked about connects Derby to Leeds, which is the town next to York that it's kind of competing against. And that's going to be part of the main trunk line going north from London. And so this other line, the York and North Midland line, is the connection to that trunk to make sure that York is now a key stop on this line going north towards Newcastle and towards the Scottish border.
Yep. I'm going to ride these rails one day. I'm going to go to the UK on Trevithick Day, and then I'm going to start my journey north on the trains.
I like it.
So the approval for the York and North Midland Railway is happening in the middle of the first mini bubble for rail shares that lasts from 1835 to 1837, and it finances the first 25 or so railway companies. And in this bubble, we're starting to see a major evolution in capital markets because these rail projects cost 5 times more than anything the markets have funded in the past outside of wars, which were funded by government bonds, right? Not by shares. Some of these projects cost over 1% of GDP all by themselves. So even though rail is a brand new sector, it actually gets to 20% of the UK stock market in the 1835 to 1837 cycle, and rail share prices go up by about 2x. On top of that, the railways are profitable, right? Dividends are healthy. Actually, the Stockton and Darlington and the Liverpool and Manchester are paying a 10% dividend. I read that the Stockton and Darlington actually was paying a 15% dividend. So like huge annual returns from these things.
Sign me up.
This is way more than double anything else that you could invest in at the time. And 2 things really stood out to me about this kind of first bubble of financing rail companies. One is I was surprised that Parliament really limited the use of debt for these railways to 25% of the total cost. And the UK government didn't really fund any of the rail build out, right? At this point, the UK government was focused on paying down all the debt they had incurred from the Napoleonic Wars. Actually, debt to GDP in the UK got to 200% from those, and it's about 160 at this time period. They're trying to pay it down. It turns out that 90% of rail investments throughout this whole period that we're going to talk about came from the savings accounts of private individuals, mostly wealthy business owners, and even major institutions like the Rothschilds or the Baring brothers. They weren't really involved, right? This isn't really what they did. They mostly set up like government bonds and things like that. This whole thing is funded by private individuals. The second thing that really stood out to me is that, canals had their own mini boom not long before all this, but by the 1830s, with railways taking off, canals are dying already. They're out of favor. No one wants their shares. This is the old technology. 10, 15 years ago, canals were kind of all the rage in transportation, and now they're already kind of in the decline. So the first phase of the rail build-out is off to a big start in the 1830s. But then in mid-1837, right after the York and North Midland starts construction, a financial panic starts that kicks off really one of the worst depressions in UK history.
The Panic of 1837. It's a famous panic.
Yeah. So this starts actually in the US, where there's a bubble in land related to the westward expansion. And the Bank of England raises interest rates to stop the flow of gold from the UK to the US, which pops the US land bubble. And it actually causes 10 US states and about half of all banks in the US to default, right? So this is a backtest episode all on its own. But for Railway Mania, British investors get smoked on their US investments. And now the UK's biggest trading partner, which is the US, is just in a major funk, a huge depression, and UK rates are going up. On top of that, there are some weak harvests in the UK in the late 1830s, which puts even more pressure on interest rates. The UK economy at this time is extremely dependent on agriculture, and if there was a bad harvest, that would really like clockwork lead to higher interest rates and higher food prices. And one really important part of this story is to understand that food was, 50 to 75% of a normal person's budget in 1830s, 1840s UK. So, of course, in 1837, investors are pulling back, railway shares are falling, really everything's stagnating. This is a real depression in the classic sense. Capital totally dries up. But in the midst of all the economic carnage, the railways that finished construction and opened are thriving in a depression, right? They're paying 10% dividends, traffic is growing, and the profits on the 2,000 miles of rail that were laid are actually pretty close to what was projected when they went through Parliament, which is insane if you think about it, that they got the projections right at this time with this new of a technology.
Railways are pretty resilient, right? Like the economy's in terrible shape, but as bad as it is, it actually leads to a booming recovery in 1843, right?
Yeah, so by 1843, the UK economy starts to come out of the depression, really thanks to two really strong harvests in 1843, 1844, which meant lower food prices. Again, food is 50 to 75% of everybody's budget at the time. And to put this Bank of England rate ease into perspective, the Bank of England is not just cutting rates here, right? They actually were able to slash them down to the lowest level in 100 years. So now you have really low interest rates with plenty of cheap food from the good harvests. And you have this huge pool of savings, right? That's been accumulating for decades from the economic growth that came along with the Industrial Revolution. That's really going to get supercharged by these strong harvests because it just made everybody could save more money on cheaper food and lower interest rates. And the most important ingredient for what happens next, you have railways. This new technology that performed extremely well through one of the worst depressions in history, right? This is something investors love,
Yeah.
right? When they can see a technology perform through a prolonged downturn, they love that. And they don't it takes a long time for investors to forget that kind of thing.
Yeah, you can't ignore that, right? If you have capital to invest, and by the way, there was a lot of skeptics in the 1830s that we read about who were saying that railways were going to underperform expectations, and they were very wrong.
Yeah, and the main thing people invested in at this time were government bonds, which rates were really low, and that was not a growing market. They were trying to lower their debt, and they invested in risky adventures abroad. They invested a lot of their money abroad.
Yeah, like Peruvian silver mines, like our friend Richard Trevithick.
Yeah, one could say there weren't many Trevithick opportunities in the 1800s. Canals are yesterday's technology. Most of the UK-based investments either don't offer limited liability or they're just too small for the huge amount of savings that has been building up and now has been supercharged by these harvests. But railways are now proven, right? You have a hot technology that is proven, and I think it's important too that it's proven to the everyday person. The everyday person has touched and felt this technology and they're using it. It was resilient through a depression and it's got tons of room to grow, right? It's got a massive total addressable market, is what George Hudson would have said if he were pitching VCs at the time, right?
Right.
And they're offering, more than 3 times the yields of consols, our UK government bonds. And also the memes are in place, right? That's a really important factor as we move into the mid 1840s. Remember how when we studied the dot-com boom, the meme was that internet traffic was doubling every 90 days, even though that was only true for like the very, very beginning, the kind of 94, 95 time period. That meme underpinned the market until the bubble burst in 2000. In 1843, we have the same phenomenon. The meme is that the number of passengers on rail is 4 times the number of passengers that travel by stagecoach. That
Yeah.
is the meme that underpins this market.
Yeah, same pattern, right? Like huge demand growth forever with minimal underlying data, but it just sounds great, so it's true.
Yep, and Parliament's all in on rail, right? In the 1830s, a lot of them owned canals, and they didn't want these ugly tracks on their land. And now we're going to get into a place where about 25% of Parliament owns rail shares, and they've seen how this impacts the value of their land, so they're all in, and the media's in too. Remember, that was huge in the dot-com era. We're seeing some things across bubbles here. The newspapers are booming. There are specialized railway journals, and investors are reading about new projects and share prices and dreaming about the future. There's a narrative cycle here that's pretty modern, and for the first time ever, it's nationwide, and it's nationwide quickly. There hadn't been any major railway project approved by Parliament since 1837. But by the end of the 1843 session, there are 91 miles worth of projects approved in that year, and the applications coming in 1844 are huge. They're more than 10 times what was approved in 1843.
Yeah, so here comes the wave. So what is George Hudson doing through all this? We talked about his work putting together what became the York and North Midland Railway in 1836. That gets built. It opens in 1839 after raising about £500,000 in capital, which would be like building, I don't know, a $1 billion data center today, right? Not the biggest project, but not particularly small either. And George is the largest shareholder of that one, of the York and North Midland Railway, and he's the chairman. But after that project, he goes from just a promoter to becoming a regional powerhouse because he starts looking at the game board and he's trying to optimize the system. He's trying to make York a regional hub by investing in and kind of influencing other railways that go north from York towards Newcastle and that go east towards the coast from York. Also lines that connect York with the main competing hub, which is Leeds. And so in essence, he's become this major force in Northeast railways, and he's not a one-hit wonder, right? He's really shrewd. He's really good at this. One of the best examples of this is how he consolidates 3 railways in 1844. They're all connected to Derby, which remember is that point kind of in the middle between London and York. There's the Birmingham and Derby junction, which connects Birmingham in the middle of England, north of London, to Derby, which is just north of Birmingham. There's the Midland Counties Railway, which connects Rugby, a town to the east of Birmingham, to Derby, again, just to the north. And none of that is important other than to know that those 2 lines kind of run in parallel and meet at Derby. And so they were in a bit of competition against each other. And then there's a third one, the North Midland Railway. And the North Midland goes north to Normanton, which is just south and in between York and Leeds. And so all this is kind of an interconnected system that is south of York. And by the early 1840s, all 3 are struggling financially. They're competing on overlapping routes. They're kind of undercutting each other's fares. It's a bit of a mess. George already controls the North Midland, so he has a seat at the table there, but he wants to merge these so they can stop the bleeding and coordinate rather than compete. And so he secretly negotiates a takeover of the Birmingham and Derby junction first. And the reason that's so clever is that the Birmingham and Derby controls the traffic coming up from the south. So the moment the deal with George Hudson leaks, the Birmingham and Derby shares spike, and the Midland Counties Board realizes they have a problem, right? Because they know that if George owns both the North Midland and the Birmingham and Derby, their railway's kind of stranded, and they might be cut off from northern traffic. And so George takes advantage of this, and he goes to the Midland Counties directors. He presents them with a pretty ruthless choice, kind of a do or die, to quote our friend of the show and pretty sure longtime listener, Benjamin Franklin. And of course, the directors for the Midland counties don't like getting pushed around, and so they push back. And George, in a very modern Wall Street way, shout out to our 80s on Wall Street series, goes over their head and directly to the shareholders, knowing that he's starting to get a reputation for being the best railway businessman. Everybody wants George to run their railway. And of course, the shareholders vote to merge with him. And so by May 1844, the Midland Railway Consolidation Act gets approved by Parliament. By the stroke of a pen, George Hudson is now the chairman of the largest railway company in Britain. And by the end of that year, 1844, he controls more than 1,000 miles of track, about a quarter of the total rail in Britain at the time. And this playbook's going to define the next couple of years of George's strategy.
Yeah, it is. And with that, this is the perfect time to thank our presenting partner, EQT Corporation.
One of the insights from our research into the railway revolution is how important it is for policymakers and industry to understand each other and to work together to sustain the economic growth that gets generated by these technological breakthroughs, while also taking into account all the second-order effects and developing policies to manage them.
That's why EQT is helping to educate consumers and policymakers on what drives affordability in electricity markets across the U.S. The data is striking. Since 2020, states like Massachusetts, California, Connecticut, and Maine have seen electricity prices rise roughly 3 times faster than the rest of the country. This is fundamentally an infrastructure problem. The natural gas to generate power is available. We have the supply. The issue is that regional pipeline projects have been canceled or blocked. Permitting takes years, and that means energy supplies can't get to where demand is growing.
Yeah, this is a problem with a straightforward solution, a better permitting process that helps streamline projects to get energy where it's needed. To learn more and explore the data yourself, go to eqt.com/energy-affordability. Big thanks to EQT for helping us bring you the stories of market history and how they apply today.
All right, so back to the story. At this point in 1844, Parliament is getting a little uneasy with the railway boom. They're worried this is going to get out of hand because they've seen this set up for a boom bust cycle in the previous decades. And so there's a big debate about like what should we do? Should we do anything? One government intervention to cool things off is called the Bank Charter Act of 1844, which is Prime Minister Robert Peel's attempt to stop banks from issuing a ton of currency and debt into the railway boom. He's trying to prevent another bust like happened in the 1830s, and actually something similar to happen in the 1820s related to the Latin American mining. Railways wasn't a part of that, but they've seen this play before. They want to stop the damage that comes from the bust, and they see the savings that's built up, and they know it has to go somewhere because it always has in the past. The more direct intervention was led by William Gladstone, who, by the way, ends up being a political legend in the UK. He's prime minister 4 times. He's very young in this story. He's kind of just getting started in government. Gladstone is at the Board of Trade. He introduces a bill that proposes, among a bunch of things, that the government should be able to buy a railway, nationalize the railway, after a number of years if it's been paying over a 10% dividend. The railway industry, they're lobbying hard against any government intervention. And of course, George Hudson is front and center and arguably the leader of this. And the railway industry kills most of the bill, but the 10% dividend benchmark gets anchored in every investor's head as the signpost for railways, right? They'd already been experiencing this from a bunch of other railways. And now the government is saying, you know, this is going to continue. And actually, they could be higher. They could be higher than this. So we need to limit it at 10%. And so this sets the market on fire. Railways start booming. They go up about 30% in 1844. At this point, about 2,000 miles of railway have been built, and about 4,000 have been approved, with a total capital need of about 100 million pounds. And this is the first year of what comes to be known as railway mania, which really goes bananas in 1845, with 2,700 miles approved, with capital needs of 150 million pounds associated with that approval. And only about 10 to 15 million pounds of that is actually invested in 1845 because, again, you're only committing 10% up front. And the stock market absolutely rips in 1845. It's up 50% in the first half of 1845. Really, the only historical comp of a major market going up 50% in a full year is the NASDAQ in the late 90s. This market does that in a half a year. And here's the crazy stat. Rail is actually 75% of the stock market at the peak of 1845.
Yeah, it's wild. We think the S&P 500 is concentrated right now because the Mag 7 make up like 35% of it.
Yes, you have to ask like what were investors thinking at this point. To put it in perspective, the S&P 500 trades at about 4 times total revenue, and NASDAQ's like 5 times total revenue. And valuation metrics weren't really a thing back then. They weren't a thing at all. But just to put it in perspective, this is a 20x revenue moment for the entire stock market of the UK in 1845. But like we've been saying, right, there's this huge savings built up. Everybody is investing in this. It's all anybody's talking about. Everybody who has money is in, right? Charles Darwin is in. John Stuart Mill is in. Charlotte and Emily Bronte are in. Everybody's in.
Yeah, Charles Dickens even writes about this. He's actually pretty grumpy that this is all happening. If you go read his stuff, it kind of sounds like some of the skeptics on the AI side today. He's very aware that the world is changing. And all these people, they all know George Hudson. They all know the Railway King. And by 1845, George, the chairman of several railways, he's also a major figure in York society, he goes for another seat of power. He runs for Parliament, not as a member from York, which had a different set of political dynamics, but he gets elected in Sunderland, which is an industrial town on the northeast coast of England, kind of straight north from York. Sunderland needs railways, and they need a new dock to stay competitive. And who better to entrust with that than the great George Hudson, right? And so some of the sources I read speculated that he spent £10,000 on the campaign, the implication being that he bribed people, which is actually not that uncommon back then, to go pay voters to go vote for you. But George had experience with this as treasurer of the York Conservative Party. Either way, he doubles down on hosting parties at his London townhouse with dukes and earls, and most of whom didn't particularly like him. In fact, the aristocracy kind of looks down on him and on all this new class of wealthy merchants. These guys, think George is a bit of a brute and maybe vulgar, but George is the epicenter of power and wealth creation, and so they don't want to miss out. And so they're hanging out around him. They're going to his parties. And then in October 1845, he makes a move that's going to matter a lot later in our story. He takes the chairmanship of the Eastern Counties Railway, which ran east from London in the south and was a commercial mess. It's been a disappointment for years. George steps in, and almost immediately, the reported numbers start looking better. The profits improve pretty dramatically, and of course, shareholders are thrilled to have the railway king running the railroad now and delivering these results. Everyone looks at George as the guy who can pretty much turn any railway he touches into gold, and he becomes the railway king. Actually, somebody labels him. This actually becomes his nickname during this time, and it sticks. But we're going to come back to the Eastern Counties Railway later, so put a pin on that.
At this point in the story, mid-1840s, everybody loves this guy, right? Everybody wants him on their team. Everybody wants him running their railway. The market is just roaring. But the Bank of England raises interest rates from 2.5% to 3.5% in the back half of 1845 for the opposite reason that it had lowered them earlier. This time we have a bad harvest. And this actually is not just a normal bad harvest. This is the beginning of something that most of our listeners will have heard of. This is the beginning of the Irish potato famine.
Yeah, the story has it all, huh?
Yeah, so it's kind of crazy that this happened right in the middle of railway mania. I had no idea. So the way the economies worked at this time is that gold has to flow out to pay for imported food. And when that happens, the Bank of England has to raise interest rates. And this is happening just as the capital calls for the railway projects are ramping up. So it's really terrible timing for investors. And 1846 is the first truly mammoth capital call year. 30 million pounds are going to be invested into railway in cold hard cash, right? Not committed in the future, actually invested in this year. That's 5% of that year's GDP. For some context, this year, 2026, the US is investing about 2.5% of its GDP in the AI build out, which is massive. So in 1846, the UK is investing double that in railways. 4,500 miles of new rail are approved with capital needs of 71 million pounds over the next 2 to 5 years. That approval is 12% of GDP.
Shocking.
Which is nuts.
Yeah.
If you look at, go read the thing we posted on Substack. This is completely unprecedented then or now, especially when you consider that all of this money is coming from wealthy individuals, not from governments, not from institutions, just from wealthy people. And during all this, rail shares are drifting lower, right? The bubble did not have this very dramatic, hero to zero moment. It's going to grind lower for 5 years. But no, at this point, 1846, nobody really is too concerned yet because operating performance is strong. They primarily cared about dividends, not capital gains. So dividends are still high. They haven't changed. And people had absorbed the lessons from the 1837 to 1843 downturn that, rails are good. They're safe. They're good long-term holds. This is just going to be another economic blip, and I'm going to hold it through like I did last time. At this point, it's really only the speculators that are getting hurt, not the original investors.
Yeah, no one's questioning the narrative, right? The memes yet, even though the market is starting to turn. And in fact, George Hudson leans into it. He brings 32 railway projects for parliamentary approval in 1846, 10 million pounds of capital for those projects by themselves. He is not slowing down. And at the same time, he's piling up the roles, right? He's elected Lord Mayor of York for a third time in 1846. He takes his seat in Parliament as the MP for Sunderland. He's chairing multiple railway companies. He's buying land on a scale that is hard to wrap your head around. The year before, in 1845, he bought the Londesborough estate, which is about 12,000 acres, from the Duke of Devonshire for 470,000 pounds. And so if you've been keeping up with kind of the price levels at the time, that is an enormous amount of money. And George actually did it to block a competitor from opening a line between York and Hull, which is a port city town southeast of York. He also buys other properties, including a new London house near Buckingham Palace, which, by the way, is now the French embassy. So still there. So just to pause on that for a second, he's a sitting MP, right? He's Lord Mayor of York. He's the chairman of several railways, and he's buying land in part as a play defending his railway interests. You kind of start to wonder, how he's managing all these conflicts. And there's a moment that I think captures this perfectly. When George becomes Lord Mayor again in 1846, one of the first things that he does is to push the York City Council to invest about £20,000 in building a new bridge, something called Lendal Bridge. And George Lehman, a different George, he's the Liberal MP for York, stands up to George and he opposes this project. And Lehman's argument is pretty simple. He says, this bridge is only going to benefit you, George Hudson. It's your railroad that's going to benefit from this. So why are we paying for it as a city of York? And he's not wrong, but George has enough control over the council and the city to push it through anyway. And I think that's the scene that kind of tells you everything you need to know about where George Hudson is in 1846. He's powerful. He's the railway king. He doesn't see conflicts, right? He's playing a different game than anybody else. He's building things, but he's really accumulating power, and he can kind of do anything he wants. The normal rules of the game don't really apply to him.
So while George is pushing that bridge project through the York City Council, the sky is really falling in the market. The first major factor here is that the 1847 harvest was like an actual nightmare, right? 1847 is the peak year of the Irish potato famine. The Irish potato famine killed 12% of the Irish population, and a lot left the country, actually, to go to build U.S. rails.
Crazy.
So the bad harvest means lots of gold draining out of the country to import food, which again means the Bank of England has to raise rates to defend their gold reserves, which go to almost zero during this time. But this time it's not 2.5% to 3.5%, right? The Bank of England has to raise rates from 2.5% to 8%, all in 1847. If you study the history of policy rates and how fast they go up, this really stands out.
It's brutal.
To go 2.5 to 8 in 1 year. And the rate on bills of exchange, which are kind of like paper currency, for people in the market, it's kind of like LIBOR. That goes from 3% to 10% in a single year. And so this is like true liquidity crisis situation. And at the same time that this is happening, another problem is that competition and overinvestment in railways, and of course just falling demand because the economy is now doing terrible, are lowering the profitability of pretty much every railway out there.
Yeah, and George is forced to play defense here in the midst of all this. In the summer of 1847, he consolidates two railways, the York-Newcastle Railway and the Newcastle-Berwick Railway, into a new entity called the York-Newcastle and Berwick Railway. And this is now one big railway that controls the trunk line going north from York to the Scottish border. And on paper, this looks like a classic George Hudson power play, right? He's trying to optimize economies of scale, and he retains the chairmanship. He controls the northern part of the eastern trunk line up from York. But this merger is pretty different, right? Remember, he was playing offense back in 1844 with this tailwind behind him where the economy is booming. Now he's playing defense, right? He's trying to minimize competition. He's trying to paper over this structural weakness in the market and in the demand profile of traffic on the railways. So from the outside, everything looks great. It looks like a classic railway king move. Looking ahead a little bit, by the end of 1848, he'll control a third of all British railway. But really, at this point, the math is getting pretty grim given what's happening with interest rates and what's happening in the markets.
Yeah, so all that, right? Irish potato famine, overbuilding, costs are coming in, 2x higher than they were supposed to. Turns out people are not taking as many long trips as was projected. They're taking a lot of short trips, which are much less profitable. All that is affecting the performance of railway companies. And in 1848, now they're slashing dividends, right? And that's a narrative violation. Remember, people had internalized the idea that railways were resilient from the 1837 depression, that dividends would sort of stay high and revenues would continue to grow forever. But now investors are starting to realize that this is different. And their 10% for life dividend assumptions were off. So at this point, shares are down 40% from the peak. They're basically back where they were when the bubble started. But by 1848, it's really the cuts in dividends that is going to be the beginning of the end for George Hudson. And to really add insult to injury for investors and just paint the whole picture here on what's going on in the markets, it's not just that dividends are being cut by, 50% and sometimes 100%, but the huge capital calls are rolling in as the massive wave of projects that had been approved 2 years before really ramp up into their construction. And investors just don't have the money, right? A lot of them had been speculating and they would buy shares just to sell them, right, to flip them to somebody else for a gain. They didn't intend to fund the capital calls, but they got stuck with the shares when the market fell because people didn't want them. Or like these are just wealthy business owners who are running their business and this is their savings, but now to fund their business they have to pay 10% on the bill of exchange, and they don't have the money to do all this stuff. A lot of people are worried they're having to sell their shares to fund their capital calls for the very specific reason that it's a legal obligation. And at this point in history, if you don't fund your capital call, you can end up in debtor's prison, which is like a terrible outcome for an investor.
There are no accounting regulations, but if you don't pay your debts, you go to prison. So funny enough, actually, there's also this excerpt that we saw from The Economist, which actually was first published in this era. They started somewhere around 1843. And a couple of years after they started, in 1845, they warned that railway capex was much greater than the country could afford. That's a quote. And this has proven them right.
Yeah, it's pretty cool that The Economist was founded in 1843 and is one of the main newspapers, covering this whole thing. And for me, I think The Economist is where the Austrian accent started, right? That's where reading The Economist in college.
Yeah. Nice.
1847 is still the largest single-year investment ever made outside of a major war. More than 7% of GDP, 44 million pounds, is called in 1847. And again, this is from individual investors. Government's not doing anything. The big institutions are not doing anything. There's not a lot of debt being used. Parliament limited debt to 25% of total capital. And so the capital need to import food because of the bad harvest and the capital need to pay for these capital calls for rails just completely, utterly overwhelms the financial system of the UK. And gold in the Bank of England vaults falls to almost zero. And remember that Bank of Charter Act of 1844 that I mentioned earlier limits total paper currency. So total money in circulation actually gets cut by about half, which triggers just a liquidity nightmare, right? Like the system is broken right now. It does not work. There's not enough money to pay for all of this food and rail capital calls.
This all sounds so terrifying.
And so, of course, this period comes to be known as the bank crisis of 1847. And they have to suspend the gold standard and suspend the Bank Charter Act so more money and credit can be issued to make all these payments, right? There just wasn't enough money. And this fixes the liquidity crisis really quickly, but the damage is done for railways because of the way the profitability suffers, the way the dividends get cut, the narrative flips. Investors are now super anxious. And, more importantly, especially for George Hudson, the press turns on George Hudson as the symbol of excess. Apparently, good old George has developed a little bit of a reputation for being a heavy drinker. And you have to remember, too, that he's new money. So the aristocracy didn't particularly like him to begin with. They were just kind of tolerating him because they were benefiting from all of his activities.
Yeah. Old money never respects new money, right? And so you got to remember, too, that George was a politician and he hadn't been the most gracious political operator throughout his career. And so he's made some enemies. He's alienated a lot of people with his power moves in politics and in railways. And now that investors are facing the reality of huge disappointment and impending losses, it's easier to question the railway king, right? Or it's just harder to suspend disbelief and just trust that everything is fine. And sure enough, on February 20th, 1849, at 1 o'clock, George Hudson takes the chairman's seat at the biannual shareholder meeting of the York and North Midland line. And he walks the members through the latest data, right? He reports on the performance of the business, which by all accounts is a fine report. There's nothing terrible happening. He announces the dividend has been reduced to 6%, and he issues a warning that dividends might have to get cut further. Of course, nobody likes this. And his reaction is that, look, shareholders, consider what's happening here, right? Like, is this a result of management underperformance, or is this really just the market conditions? Look around, right? That's what he's implying. Just look around at the market conditions. The meeting wraps up. It's business as usual. No big deal. They take a quick break and they get ready for another meeting that happens immediately after. The room kind of fills up again. It's a new set of shareholders, but now it's the meeting for the York, Newcastle, and Berwick Railway. George again takes the chair, walks them through the performance of the last 6 months, proposes a dividend of 6%, which is cutting the dividend by 2 points from 8%. Again, blames market conditions. This time, though, as shareholder, this guy, Robert Prance, he stands up and he asks a question. He doesn't ask about the dividend. He asks about the company's agreement to purchase the shares of another railway, a railway called the Great North of England. And this is a pretty complicated transaction with kind of lots of moving parts, but the gist of what Prance is saying is, hey, I looked at the data that you all published, directors, for our company's accounts. And this agreement that you made to buy shares that had a face value of £15 in 1846, at which point only a fraction of that capital had been called. And at a point in the market when those shares were actually trading on the exchange at 31, so about double the face value, why did we pay £35 for these shares? And who benefit from this, right? Like, who sold shares to the company at that price? And so, of course, he's implying that George did, that George is self-dealing and that he's selling his personal shares in another company to this company when he's in a position to authorize those transactions for himself. And he's doing it not to benefit the company, but to benefit himself. And so for a bit of context too, right, this isn't the era of index funds and security regulations that we're all used to. This is kind of direct shareholder governance and laissez-faire, where everybody is expected to deal with their financial decisions themselves, right? Like, the state is not going to get involved in any of this. And so George Hudson replies to this guy, Robert Prance. He says, you know what? I didn't do anything wrong. And I don't have the books here to confirm who sold what and when, but I can tell you I was the seller of about a third of those shares. And if I sold those to the company at a higher price than I should have, I'm happy to refund the company with interest. No big deal. It's like, he's basically saying, like, no, nothing to see here. This is not a big deal, Mr. Robert Prance. And so, of course, Prance pushes back and says, hey, this isn't a question of money. It's a question of reputation.
Uh-oh. Here it goes.
Yeah, so we're in Victorian Britain, right? Honor, integrity, honesty, this stuff matters, right? Like, the social dynamics of the period are all about reputation. And after a pretty animated back and forth between George and Prance and then several other shareholders, some of whom were actually defending George, the shareholders vote and they agree with Prance. And they vote for an investigation. So one of the books describes this as an ambush. Like, the point isn't really to uncover one instance of self-dealing. The point is to take down the railway king. And this ends up triggering a domino effect, because the moment that the York, Newcastle, and Berwick Railway approves an investigation and George's reputation is called into question, nobody wants to be seen with George. Nobody. And in fact, he had a meeting of MPs shortly after this shareholder meeting, and he gets a message from the MP that's hosting this meeting. And the message says that George shouldn't attend at all. He says, in fact, he shouldn't make any public appearances until the railway issue is settled. Again, these guys are super worried about their reputation. And so they don't even want to be seen with George at this point. And not only that, but now there's blood in the water, right? And so every other company that George controls starts asking the same questions. Like, hey, if there's questionable stuff going on over there, what about here? And so George, it's hard to say actually if he's taken the advice of the MP or if he's just realizing what's coming. Maybe he's anxious, but he is supposed to chair the shareholder meeting for the eastern counties a week later on February 28th, 1849. But 3 days before that, he writes to his deputy on the board and he says, I'm not going to be able to make it. And so his deputy writes back. He's like, what do you mean you're not going to make it? This is not a good idea. You need to show up. How are we going to explain that you're not there? You're the chairman, for God's sake, right? And George doesn't even reply to that. And he doesn't go. And the meeting starts. All the shareholders are demanding to know where George is. Nobody knows. The meeting wraps up. And apparently it wraps up with this. This is so Victorian. This is what they said. They said 3 cheers for Mr. Waddington, who had chaired the meeting, and 3 groans for Mr. Hudson. Ooh. Burn. That's a Victorian burn. And so now there's, of course, advertisements in the press against George. Things are getting real. And some of these are placed by political and business rivals of him. So they're kind of adding fuel to the fire. And one by one, every one of George's railways are heading towards internal investigations to audit the books for any inconsistencies or any kind of questionable moves that he might have made. The Midland Railway schedules a special meeting of shareholders in April, where George actually resigns from the board via letter. He doesn't show up. And an investigation gets approved there too. And then a special meeting of the York, Newcastle, and Berwick in May. Remember, this is the first one. This is the one that started all this with Robert Prance. George also sends his letter of resignation from that board. And then later in May, he resigns from another one, the York and North Midland too, which was actually his first railway project. Remember, this is how he started this whole thing, bringing that rail line to York. And that meeting also approves an investigation. And by this point in 1849, George's reputation is completely broken. But believe it or not, this is actually only the beginning, because everything he built really over the last 2 decades of deals and fundraising and managing railways is now called into question. And the question is, was it all real or was it a house of cards? Well, get ready because what the investigations find is absolutely devastating for George. Because I told you to put a pin on the Eastern Counties Railway, that line that was going east from London. Well, bring that back because George took it over when he was struggling. On paper, it looks like he turned it around, but in fact, he had cooked the books. It was not real. The investigation comes back. It turns out that he overstated profits by 40 to 60% from 1845 through 1848. One of the investigations finds that he had sold land to one of his railways at inflated prices. Several other investigations end up showing that he was paying dividends out of capital. So he's effectively taking capital that was called in to fund construction and using it to pay dividends to keep up the charade, basically like a Ponzi scheme. On the other hand, the investigation committee at the York and North Midland actually makes a really important point. They say that the company's original trunk lines were genuinely profitable. The 10% dividend that it was paying was legitimate. But the problem that they found is that the branch lines they had committed to, those lines were not profitable. There was tons of cost overruns in those, and they had lower than projected revenue. So those are not good lines. Meanwhile, as these investigations are coming in, George is actually trying to save himself by paying back any profits he personally made from self-dilling. So he's still trying to figure out how to get out of this hole. That's not helping. It's a one-way street downhill.
Yeah, and all this is really key to understanding what kills railway mania. We go from the bank crisis of 1847 to railways underperforming because of the economic downturn and because there are just too many of them. They're cannibalizing demand from each other. And because there are these huge cost overruns on all these projects. And then the other shoe drops, right, which is all these fraud discoveries related to the Railway King. And the railway share index bottoms out in October 1849, down 70% from the peak in the summer of 1845. Dividends are cut at least in half, sometimes by much more. This is a massive wipeout. And since this is individual people funding this, this is really hitting, ordinary families all across the UK.
And to wrap it all up for George, this is really the end of the line for him, right? His empire completely unravels at this point. He's expelled from the York City Council. He's forced to sell most of his assets. The only thing he holds on to is his MP seat in Sunderland. The people there really loved him. And, he had saved the town with some docks and infrastructure projects that he had helped build. And actually, the fact that he keeps that MP seat is the only thing that keeps him out of debtor's prison until 1865, at which point he's no longer an MP and he gets thrown in debtor's prison for a couple of months before some friends raise the money to get him out. So on that note, Matt, let's do some takeaways. What do you want to leave our listeners with on this one?
The things that really jump off the page for me after studying the rail build out in the UK. First, the initial rail build out actually happened across 3 distinct cycles across 35 years. We talked about the first 2 in this episode, one in the 1830s and then railway mania in the 1840s. There was a third major push from new rails in the 1860s too. And so it has me asking the question of, for example, what is the harvest of the late 2020s? Meaning, what are the things that really have nothing to do with the booming technology of AI in this case, but could knock the economy off its tracks for long periods of time? I don't think we have anything like food prices in the 1840s.
Yeah, well, you made a good point. You sent me a text earlier this week speculating that maybe oil is the governing input to macro shocks in modern times, more so than harvests, right? But they're the equivalent. And I don't know, maybe this year we're about to find out given what's happening in oil markets.
Yeah, so I think it's got to be something like oil and interest rates. A second major takeaway for me, you have to be bottoms up and top down, not just one or the other. On a bottoms up analysis, meaning your particular rail investments and you see the 10% dividend hitting your account every quarter, it's actually pretty easy to see why investors paid 2x and even 3x the IPO price in 1845. Because if you assume 10% dividends forever, then this was still a much better return than anything in the market at the time because of how low interest rates were. But if investors had zoomed out to look at the broader economic and competitive system that rail was coming into, they could have seen that it was unlikely that rail was going to absorb every dollar of available investment in the UK for the next 20 to 30 years. And they could have seen that it was unlikely that rail was going to become bigger than the entire UK government by 1850, right? That's what was priced in to the revenue projections.
Right.
Andrew Odlisco calls this a collective hallucination in one of his papers. And the data on demand and revenue were there, but nobody really looked at it, right? Everybody just kind of bought into the memes and stared at their 10% dividend, right? Just kind of heads down, right? And you didn't need an insider access or sophisticated model, even at this time, to see that these projections were unrealistic from a top-down perspective. You just needed to check. And I think in these manias around new technologies, people tend to not do that.
Yeah, I think those are excellent takeaways. I think you always have to ask, what are the economic fundamentals telling you, right? So that's a good one. For me, the lingering question in this story is, what should we make of George Hudson? And as fascinated as I was by the mechanics of capital formation and all of this and how these projects got structured, the question that kept gnawing at me the whole time is, was George Hudson a good guy or a bad guy? Right? He doesn't really fit any of the molds that you might try to use for him. He's not an Elon Musk or an Aubrey McClendon or a Michael Milken or even a Sam Bankman-Fried, right? Like they rhyme, but he doesn't really fit any of those very cleanly. And so when you study him, and we went really deep, I didn't find a satisfying answer to that question. On the one hand, he was probably one of the best builders in world history, right? Like I would argue that he's just as consequential as George Stephenson and James Watt to the Victorian Golden Age, fueled by the Industrial Revolution and in large part by railways. He was one of a kind. This combination of incredibly charismatic and visionary fundraiser and this systematic consolidator of railway systems. He had exceptional execution and strategic skills. And yet, you also have to acknowledge that he was cheating to achieve some of this. By the way, this feels like Lance Armstrong in the 2000s, right? Like everybody was operating this way. George was just the best at it. But regardless, he was being dishonest with the people that were funding the things that he was building. So it's not that what he built was necessarily bad, but he exploited people's trust and to some extent ignorance in order to get those things built. And he hurt a lot of people financially in the process. So do the ends justify the means? In my mind, no. And he paid for it with his legacy, right? Because history remembers his fall from grace more than any of his contributions to ultimately the engine that fueled this booming economic growth in the 1800s.
Yeah, no, when I think about George's legacy, two things come to mind. One is that the railway projects that he supported are actually mostly still operating today, right? So he tended to only get involved with good projects, but also the modern accounting industry, the modern auditing industry formed as a result of this, right? So it's very much a split on his track record.
Yeah, for sure.
Should we leave it there?
Yep, great story. One of my favorites.
All right, well, thank you. If you enjoyed this, as always, the best way to help us is to share this with anyone you think might like it and to leave us a 5-star rating on Spotify or Apple Podcasts. And of course, to tune in for our next episode.